So these are the things you need to know before the opening bell rings on Wall Street. We start with trade. So the July 9th deadline to secure deals with the US has been reset to August 1st. But just who could get a deal done and avoid a huge hike in tariffs? Well, believe it or not, it looks like the European Union could be top of the list. The bloc, made up of 27 European countries, said it's closing in on a framework trade agreement with the US. The optimistic claim came about after a call between President Trump and the President of the European Commission, Ursula von der Leyen, on Sunday. Now, the EU is willing to accept a 10% universal tariff on many exports, but wants the US to commit to lower levies on key sectors, such as cars, steel and aluminium. Now, if a deal isn't done, then the tariffs on all EU exports to the US will jump to 50%. Now, the EU did not receive a letter that said it would face higher tariffs, but 14 other nations did, including two of the US's biggest trading partners, Japan and South Korea. The president said that he would impose 25% levies on them from August the 1st. The president has ramped up his rhetoric against Tokyo recently, hitting out at Japan for not buying more American rice. Japan's prime minister said that the letter he received was, quote, truly regrettable. Now, South Korea's negotiations have been delayed because of the political turmoil in the country following the impeachment of President Yoon Suk-yeol. Now, both countries insisted that negotiations with the US were ongoing. Now, one big beneficiary of these tariffs on Monday was the US dollar. It jumped the most in 3 weeks, a sign that investors believe the world's largest economy can largely withstand the impact of trade disputes. Against a basket of currencies, it was up around 0.5%. In Japan, the yen fell by over 1% at one point, hitting its weakest level in 2 weeks. In South Korea, the won also slipped by over 1% against the greenback. But don't forget, the dollar has been in decline this year, though investors are now perhaps recalibrating after last week's strong payrolls data adding to support for the dollar. Well, speaking on Yahoo Finance's Market Catalysts, Thierry Wisman, a global FX and interest rate strategist from Macquarie, gave his take on the dollar's performance this year and US exceptionalism.
Prevailed only in the back half of 2024. The dollar has been a strong currency for the past 13 years. It's been generally increasing or rallying or appreciating against other currencies, both in nominal terms and real terms, since 2001. So if you're going to talk about American exceptionalism as being somewhat equivalent to the appreciation of the U.S. dollar, the strength of the U.S. dollar, effectively we've had American exceptionalism for 13 years. And if you point to the headlines, of course, in the history of these last 13 years, it certainly does seem to support the idea that American exceptionalism has been around that long. We've had a lot of small economic revolutions in this country that have produced productivity, produced growth, and it's been superlative, effectively, at least the way the market has interpreted relative to what has been going on in other countries over this 13-year period. So American exceptionalism has been going on for 13 years. Now the question is, are we at a point where after 13 years of this, we are going to start to go in reverse? I think to some extent we are. One reason is that these periods of American exceptionalism that are matched by dollar strength don't usually last more than about a decade. So we're kind of overdue for a turn. The other issue, of course, is that we've gone in these 13 years to a point in which U.S. asset values and the value of the dollar has gotten very rich, objectively speaking, if you just look at these long-term charts. That's another reason. And of course, with the change of the administration and with the policy uncertainty that has come with it in the last few weeks and months, there now is a compelling reason for asset allocators abroad to start winding down or dialing back their dollar exposure, both their U.S. asset exposure and the attached dollar exposure. And I think those three things, working together, are what's going to cause the dollar at least to go into, I wouldn't call it a tailspin, but certainly a period of weakness here. So I don't think that we are going to get back to these highs that you alluded to earlier that prevailed in the very beginning of this year before this down move. I think that's a thing of the past. And I think that the dollar is going to be weighed down by a few factors going forward. And it could last a few years.
how do the trade deals play into all of this, right? Because one would think that as these deals get signed, or at least you get a framework or a letter of intent or what have you, that would be positive for the dollar, but it hasn't always played out that way. So what do you think?
No, it hasn't. And I understand where that logic comes from, right? Because on April 2nd, when we got the reciprocal tariff announcements on Liberation Day, the dollar fell. And so people began to attach the idea of the U.S. disassociating itself from the rest of the world through these trade tariffs as something that is negative for the dollar. But then when we started to see the U.S. walk back this level of pugnacity and aggressiveness with regard to tariffs, when we started to see some deals come through, the dollar didn't appreciate back. And that leads me to believe that there's something else at work here. It may be this broader policy uncertainty that's at work. It may be this view that the dollar has gotten too rich and U.S. assets have gotten too rich, regardless of what happens with the tariff situation, that is compelling other investors around the world to pull out of the dollar.
Well, that was Thierry Wisman from Macquarie talking to my colleague Julie Hyman last night on Market Catalyst. Now it's time for Trending Tickers. So you'd think after the tariff letters for Japan and South Korea, we would see falls in the main indices there. Well, actually, the Nikkei edged slightly higher, but more impressive was South Korea's Kospi. It actually closed over 1.8% higher. In fact, in general, Asian markets saw their shares gain across the board this Tuesday. It seems that investors are still cautiously optimistic that Japan and South Korea can reach trade deals ahead of the US's newly extended deadline. Well, since the lows both indices saw after April's Liberation Day, they have recovered, perhaps reflecting the feeling that not only will Japan and South Korea strike deals, but other trading partners in the region will also be able to do so. Now, staying in Asia, and one ticker to really keep an eye on today is Samsung Electronics. It closed slightly down today after the company flagged that it expected sales and operating profits to fall in Q2. In fact, the South Korean firm predicted that it will post a 56% drop in second quarter operating profits. It's been hurt by US restrictions on China and has struggled to supply its key customer Nvidia with advanced memory chips. Now, one to watch after the opening bell rings on Wall Street, and that's Uber. Now, shares in the ride-hailing company rose over 3% on Monday to close at an all-time record high. And in fact, futures are pointing to another positive day this Tuesday. The stock is up more than 60% this year alone. Over the same period, the S&P 500 is up just 6%. One thing that could be helping Uber is the muted response to Tesla's robo-taxis event in Texas 2 weeks ago. Now remember, Uber and Waymo have expanded their partnership to offer autonomous ride-hailing services in Atlanta and Austin. Now, a ticker that's not a ticker. Well, not just yet. We're talking about China's fast fashion retailer Shein. The Financial Times reported that Shein has confidentially filed for an IPO in Hong Kong. It's seen as an attempt to speed up the drawn-out process that it has been facing trying to list in London, where it's faced regulatory hurdles. Now, Shein actually filed for its London IPO around 18 months ago. It's also worth noting that IPOs in London have sunk to a 30-year low in 2025. Well, it's time now for a break, but coming up after, we'll have part one of our interview with President of Cisco, Jeetu Patel. He's got a very interesting take on AI, so stay tuned. Welcome back to Morning Brief Market Sunrise. We'll now kick off our deeper dive into AI, starting with the President of Cisco, Jeetu Patel.
So we've been around for 40 years. We still power the internet and networks, but we are so much more than that now because we're also one of the world's largest cybersecurity companies in the world. We acquired Splunk, so we have a lot of kind of data and log management and all of those aspects of the business. Collaboration is a big business for us, so WebEx and telepresence, which used to be what it was known for, is now kind of a very immersive experience that you have in the rooms as you get into this hybrid work mode, although it's nice to be in person. And so basically, Cisco has moved from being a hardware company to now being over 50% in software revenues.
Now,
I'd say subscription revenues rather than software. Yeah.
So I was looking at your website, and there's a
Yeah.
banner on there which promotes your presence in AI. It actually says Cisco is where the hype ends and meaningful help begins. What does that actually mean?
So it's probably worth taking a step back on what's happening in AI so that I can then give you what we're doing. So we are probably, Ramzan, going through one of the most consequential shifts in the history of humanity, and we are in the second phase of this AI movement. So the first phase was 2.5 years ago. You had ChatGPT that came out, and you had these chatbots that were able to answer questions intelligently for us, and it kind of felt like magic, 2.5 years ago, we're now at the stage where we're going to the next phase, which is instead of chatbots answering questions intelligently, we're going to agents being able to conduct tasks and jobs almost fully autonomously on behalf of humans. And this will fundamentally change kind of the entire throughput capacity per capita exponentially. So what chatbots were probably 10 to 20% improvements in productivity, this will be 10 to 20x improvements in productivity, if not 100 to 200x. And so I feel like there's going to be a massive kind of surge of productivity that'll happen. And these autonomous agents are going to be proactive in nature. Today, you see these autonomous agents that might operate for about 20 minutes by themselves. Think about deep research. You ask it a question, it goes out and does some work, comes back to you with a consolidated answer. Over time, it might be 2 days, might be 2 weeks, might be 2 months, might be 2 quarters. The longer the time it takes, the more progress we'll be able to have. And I feel like one of the most underhyped aspects of AI is this notion of, original insights that can now be generated with AI that we could never generate in the past, that can allow us to solve problems that we could never, imagine. So then the question is, what are the constraints? Why doesn't every person have the benefit of AI? It's because one of the big constraints is infrastructure, and one of the other big deficits is trust, people trusting these systems. On the infrastructure side, there's 3 big constraints. There's power, compute, and network bandwidth. And then on the trust side is safety and security. So if we get those pieces solved, we can really unlock AI, and that's what Cisco is in the business of doing, is providing high-scale infrastructure for the data center build-outs, as well as providing safety and security.
So just want to delve into those numbers you gave. Are they your own estimates in terms
Those
of
are just estimates of what I think is going to end up happening. Those aren't, backed by any research or anything, but you could start to see and feel it, because if you have an agent that's going to be able to automate a workflow versus you asking a question and getting a productive answer back, there's going to be a meaningful kind of uplift in the throughput capacity per capita.
So this is clearly your way of trying to, muscle in on the AI market. Do you think that will help you dominate AI going forward? I mean, there's a lot of competition out there. Other companies who are trying to do the same thing, no?
Well, so if you think about the where we are very unique is our networking friends don't really have a security platform, and our security friends don't really have a networking platform. So the fact that we've fused security into the fabric of the network really makes us very unique. The other thing is, when you start thinking about what is happening from these data center build-outs, the way I think about it is there's 3 big problems that we solve. The first problem we're solving is helping organizations build out AI-ready data centers, right? The second big problem, and that's where all the digital workers are going to live. Think of it that way. The second big problem is helping make sure that organizations can future-proof their workplaces. That workplace could be a campus, it could be a branch, it could be a home office, it could be a factory floor, it could be a store. Whatever those workplaces are, we want to make sure that we can actually equip those workplaces for high performance, low latency, high energy, kind of efficient energy consumption based networking and security. We're actually doing that, and the beauty is we've got the connectivity fabric to tie those together. So a human in a workplace can actually collaborate with an agent in a data center seamlessly, and all of that infrastructure should be resilient. Now, to your question, how are we unique? Scale is actually what makes us very unique. And the second piece is so I was just recently about, I don't know, 3 weeks ago, so I was in the Middle East with the President of the United States, with the Saudi government, with the UAE government, and we met all the world leaders over there, and we're starting to see that there's massive data center build-outs happening in that region where you should expect Cisco to participate in that in a pretty meaningful way.
That was Cisco President Jeetu Patel speaking to me here in our London studios. And stay tuned for more on that interview later this week. Anyway, it's time for a break, but don't worry, we still have plenty more from the world of AI. So see you after the break. Welcome back to Morning Brief Market Sunrise. So you heard it from the president of Cisco. Silicon Valley is doubling down on its AI expansion, and it's ready to invest as heavily as it can in staying ahead. In other words, the AI race is heating up and investors are placing big bets on winners and losers. Let me break it down for you today. So let's take Cisco as an example, since we just heard from them. As you can see, Cisco stock is up nearly 30% since April. What you may not know is that Cisco has made some strategic investments in other companies. Just to mention one of them, CoreWeave. That's a company that runs AI cloud data centers, and it famously has a partnership with Nvidia. We've been covering them here on Yahoo Finance. Well, CoreWeave is up about 300% since its IPO in March, and it's actually around 220%, since March, when its IPO was launched. And the Cisco-backed company has been hitting the headlines this week due to its all-stocks purchase of Core Scientific. The deal-making spree is another strong indication that companies are now accelerating plans and making bold moves to lead in AI products and services, from data centers to consumer products. Probably the most blatant example this morning, Meta. Just look at this chart. Meta bounced up while Apple is down. Just look at this white line coming up right now. Well, this is following the news that Meta has poached Apple's top AI models executive, according to Bloomberg. Mark Zuckerberg's company offered a package worth tens of millions of dollars a year to Ruming Pang, a distinguished engineer and manager who had been playing a key role in Apple's AI efforts. Now, the news seems to be a big setback for Apple, which has been struggling in the AI space, and a milestone for the top team that Zuckerberg has been looking to assemble for his new superintelligence unit. Now, Meta has been a key driver of gains for the S&P 500 in recent months, although concrete results are still yet to be seen. Another AI stock that's been shining again recently is, as I'm sure you've noticed, Nvidia. So why is there so much spending and optimism right now in the space of enterprise AI? Here's one answer from analyst Patrick Moorhead. He joined my colleague Josh Lipton on his Yahoo Finance show, Market Domination Over Time.
Let's begin with Nvidia.
Sure.
Big run off the April low. A name a lot of people know, a name a lot of people watching right now certainly own. What explains that move off the April low?
Yeah, so a lot of risks were taken down. You know, it was screaming for so long, and then tariffs hit, China hit, potential GDP concerns, even questions about CapEx. And nearly all of them just completely evaporated and came off the table. So the risk is lower in the perception with investors. And for the first time, this gear of the potential next wave of industrial AI, investors are starting to see the correlation and the potential upside.
You mentioned CapEx, which is an interesting point, because there were some skeptics we had on the show who were arguing, Patrick, that maybe 2025 is going to represent some sort of high mark, some sort of peak in AI CapEx, and that was bad news for the likes of Nvidia. Do you buy that?
I don't, but I do think the growth will be tempered, right? Will we see 10% growth, 20% growth? Likely. We won't be seeing 50% growth. But the only thing that could change my mind on that is I'm doing a little bit more research on the industrial edge and also enterprise AI, because as AI gets permeated into everything, into businesses, on premises, and even in the industrial edge, somebody is going to have to pay for that equipment. And if it's not going to be who you might expect, let's say the carriers, the folks who are out there investing in it today, other companies might have to come in Let's say the hyperscalers go after that.
Now, we have a special bonus clip today. Yahoo Finance senior reporter Claire Boston joined Julie Hyman to share some tips as to where in the US you can still afford to buy a house.
So the three remaining places where it's pretty affordable to buy a home is St. Louis, Detroit, and Pittsburgh. So, head to the Midwest, or in the case of Pittsburgh, near the Midwest. And what makes these cities affordable is really that the home prices are low. In all of these places, you can buy a home for under $300,000 on average. Household incomes here aren't particularly high. They're about average, think $70,000 to $80,000. But if your home costs less than $300,000, that is still affordable, in terms of spending less than 30% of your pay on that mortgage payment and your insurance.
Yeah, so good news in those places, I guess. And Claire, we saw the 30-year fixed rate mortgage fall for a fifth straight week on Thursday. How much further do they need to fall to unlock more affordability for home buyers?
Right. So it is exciting to see a mortgage rate below 6.7%. It has been a bit of time since we have seen that. That being said, it does not really move the needle at all on affordability. Home prices are just so high on average right now. We would need to see mortgage rates below 4% before any sort of significant affordability was unlocked here. And, pretty much every expert I talk to says there's no way that's going to happen, barring, a catastrophic recession. So, kind of bad news for the housing market right now, at least at these prices.
An interesting take there on the housing market in the US. Okay, before we go, let's have a quick look at where the futures markets are pointing to Wall Street's open. And yeah, a bit of a mixed bag there. The Dow is down slightly but the others, S&P and the Nasdaq, looking slightly more positive. Now, overnight, Goldman Sachs have come out with a prediction for the S&P 500. They're predicting 6,600 by the end of the year. Well, thank you very much for watching another episode of Morning Brief Market Sunrise. I'm Ramzan Karmali. Stay tuned to Yahoo Finance to watch more unbeatable financial information from my colleagues in the US. Have a great rest of your day.